Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hold on, my things aren't quite right here, so let's get it going here. How's that? That's a little bit better. Oh, you know, I must have restarted the machine and I didn't realize that I don't hear the music. You hear the music, I don't. I know I don't. I can't hear it. Also needs to be down here. And the speakers needs to be turned off. As soon as that went on, I could feel my subwoofer. I'm like, whoa, hold up. Hold up, that's a little bit too much. Okay, so sorry about that. I'm a little bit late. So I have this issue where, like, if I restart the machine, things get screwed up a little bit, like the order of the monitors change and stuff like that. So anyways, on Friday, I left you guys saying Jerome Powell's going to have his big speech, and I would expect him to push back on the dovishness. And this was another one of those situations where I was largely right, but ultimately wrong, because Jerome Powell did push against the dovishness, but apparently it was not enough. The market kind of focused more on the things that he didn't say and essentially read it as extremely dovish. And I think you're getting some pretty crazy CTA flows coming in. Treasuries moved significantly higher, as you'll see here in the charts in a second. So there was a really big shift in the markets on Friday. So today we kind of get to see the counter moves, to see, kind of where we settle back to. So let me show you here on the charts. Where is it? Okay. So you can see here on ZN, after Powell's speech at 9 o'clock, basically, we just took off. I mean, we were already up on the day, but we really took off. And this is a pretty big move. I mean, it's not the biggest move, but it was a hot handle and then some. So pretty major move. Now here, overnight, over the weekend, we did come back a little bit. So I think that CTAs were probably getting involved in here and so forth. And so we kind of get to see how things settle back down now that the CTAs have taken their positions. I don't know if they're all long or what the deal is there. I'm sure there's probably still some flow to come in on that side. And I think that overall, I would have to, except for today, I would probably be still biased towards the longs. Now, in the S&P 500, you also got a pretty massive rally off of this, but they are coming back here. So, oil continues its decline. That's interesting. I really thought this was maybe a spot where they could break out, but everybody's saying now they're not going to hold to the output cuts. So it's funny they got the deal done, but getting the deal done basically made everybody say there's a problem and there's still going to be too much supply. Gold and silver, on the other hand, oh man, gold and silver. So there was a pretty decent rally off of Jerome Powell. So again, the market seems to think that the Federal Reserve is going to be easy. And when I see gold jump up like this, really makes me concerned about if how much this will hurt the currency. Because I mean, the dollar is coming back. Well, they're at 103.26 right now, so it's not too crazy. But basically, there's this whole scenario where they do back off on interest rates or whatever, and the market takes it so bullishly that it leads to another bout of inflation. And that's what I think gold and silver would perhaps indicate here. So gold and silver were up really big overnight. Copper was up, but it has kind of since reverted, right? Now, another one that moved off of all of this was Bitcoin. Look at that move. And you know what? I need to add more data series here. I only have like 5 days, right? I probably should have like 90 days, okay? So if you add a little bit more time in there, you can kind of see how Bitcoin has been in a range, but like slightly to the upside, and now they are moving up into another range. And this is the first time in quite some time that they're over this key psychological level of 40,000. So Bitcoin is also running on this. So it's kind of interesting because you might think that there'd be a risk-off move, right? And if there is a risk-off move, I would anticipate that Bitcoin gets hammered really, really hard. But so far, it is not a risk-off move. It is just they're gonna, more money is coming sort of a move, right? It's not like they're turning the money printers on, but they expect interest rates to come back. So the whole market is reacting. I am still very not convinced. I'm not going to say that I don't think it's going to happen, but the market seems to be extremely confident now that they're going to be reducing interest rates maybe like second quarter of next year. And I just don't see it, man. Like, yeah, the economy has gotten weaker. Manufacturing in particular, the manufacturing PMIs have been in contraction almost all year, except for the one that we got last week all of a sudden is positive. Sales this year for Black Friday and everything have been really good. People are talking about it like that the consumers are splurging. I think that there's probably alternative explanations, right? I think that the US economy is probably not as rate sensitive as it has been in the past. People got all of the cheap debt that they needed back when interest rates were low, companies in particular. And so when you raise interest rates, it doesn't really slow things down as much as it has typically in the past. And I think that that's why you're seeing the economy be stronger than anticipated. And that to me means that they will have to keep interest rates higher for longer than anticipated, which means that they will probably be keeping them where they are through 2024. That's kind of my forecast, but I'm not going to say that I'm good at making a forecast like that. It's just what I see right now. Octavius, you see hyperinflation coming? Well, I think that, the Federal Reserve's plan could be to keep interest rates higher for longer, and the market could, because of doing its thing, like way overreact and think that the interest rate decreases are coming and create inflation. It could happen. Yes. Okay, so now the reason this all matters to me right now at this moment is because even though we can't see it because there's a bug in Jigsaw, we do have a long in the S&P 500, and we're glad that we have held it. But when do we take it off? And the plan was to take it off sometime this week. Well, I think that what we're seeing with these interest rates coming off, of course, they are going to mean revert a little bit here today, I think. But what we're seeing in the S&P 500 is a lot of rotation. So they are now rotating towards more rate-sensitive sectors. It's kind of funny because one of the things that gets hit with lower interest rates or higher interest rates, let's say. One of the things that gets hit with higher interest rates is tech companies and big tech companies in particular. And they did get hammered when we had the first bit of inflation. But then since then, they have kind of become like the whole market. So they're not exactly the same play as I originally thought. But now that we are moving into a lower interest rate environment, The Magnificent Seven are pulling back considerably, and you're seeing the money moving into things like small cap Russell stocks, for instance. It's kind of coming. So this rotation is coming. When you get that kind of churn, it can be a difficult trade in the S&P 500, right? But I think that should still be able to allow the S&P 500 to push a little bit higher this week. We'll see. I guess I should come over here and go through what news we have for this week, right? So there's not a whole lot today. We got factory out orders and that's it. I want this week. This week. Okay, so tomorrow we get the ISM Services PMI. We just had the manufacturing PMI, which was better than expected. And then on Wednesday, we start to get all of the jobs, the normal like first week job stuff. So ADP non-farm employment change, unemployment claims. And then on Friday, in addition to the non-farm employment change, the big one, we also get consumer sentiment. So, a decent amount of economic news this week. Now, let's see here. Do we have... Oh, we do, actually. So, the consensus for the non-farm employment change is 185 versus a previous reading of 150. So, if we come in here, you can kind of see how this was the first time in a long time, by the way, that we missed the estimate. We missed the estimate. They wanted 178. We got 147. Markets like that, right? And now they expect it to be more like 180. So higher than both the expectation and the reality last month. If we get another reading like we did in October, then oh my gosh. But hopefully that doesn't happen. So non-farms, I think generally we have a risk of overperforming. And if that does, I would expect the S&P 500 to sell. So probably I need to take my trade off. Well, so maybe I need to take it off tomorrow. Maybe I need to take it off tomorrow. Maybe I need to take it off today. Except for that, here's the thing. I don't know how to take it off. There's no way for me to do it. I have to ask a Jigsaw to fix it. Lucas says, interesting. Yeah, it is interesting. We're at a very unusual time. I mean, we've been on unusual times, but we're kind of coming to what I would think of as like the end of the unusual time and the beginning of a new unusual time, right? Okay, so treasuries. So far, cumulative delta pre-flat, there has been some selling in the 30-year, but they have subsided the downside move for now. Oh, geez. I'm going to have to watch that. Linus Tech Tips has a video about 3D gaming mice. Oh, I have oil over here. Yeah, we put oil up. I put oil up just because that seemed to be the most popular. So, you don't really need it. Could get rid of it and just expand the ES chart over like that. Or sorry, not the ES, the dollar chart. But Let's see here. Bitfinex retweets John Reed Stark. Trying to explain why Bitcoin's price continues to rise is like trying to describe the clothing worn by ghosts. For crypto, there's no inherent value, there's no cash flow, there's no yield, there's no employees, there's no management, there's no balance sheet, there's no product, there's no service, there's no history of operations, there's no analytical valuations, there's no earnings reports, there's no proven track record of adoption or reliance, there's no data of any kind except for analytics relating to crypto speculation, which are inherently suspect, e.g. the reported 90% likelihood of the SEC's approval of the Bitcoin spot ETF, which is absolutely absurd. I agree. Oh, I so agree with that. The crypto analysts saying that there's a 90% chance that they will approve the ETF is absurd. I agree. Crypto prices go up and down for two reasons. First, because there is no regulatory oversight to prevent market manipulation, and second, because people are able to sell hype FOMO'd overpriced crypto to a greater fool, whether or not the crypto is overvalued. That is, of course, until there are no greater fools left and then it all comes crashing down. Crypto has failed miserably in its mission to serve as cheap online cash, failed miserably in its promise to solve the problem of financial inclusion, and failed miserably in its goal to evolve into a true store of value. Nonetheless, crypto keeps on reinventing itself while its manipulation by a few big crypto fat cats keeps the celebration going. The stark reality is that terrorism, crime, and pure speculation are the only actual crypto utilities, yet crypto enthusiasts continue to promise that crypto must be the solution to something, but precisely what remains a mystery. Binance guilty plea shows what crypto is really about from the Wall Street Journal. He has links to a story. So I think he's correct. I do think that there's some manipulation going on. But it's curious, the move that happened this weekend, and it happened along with silver and gold. So I do think while there is some price manipulation going on, I think that this buy over the weekend was probably more genuine than other buys. And there does appear to be like an inflationary hedge sort of a trade going on in the markets right now. And Bitcoin is a part of that, and so we got to keep an eye on it. So why does Bitfinex think it's a manipulated market? Well, here he tweets CoinDesk, LUNC, Luna, USTC tokens linked to the Terra ecosystem have more than doubled over the past week, extending year-to-date gains by more than 10,000%. Yes, probably manipulation. When are they going to manipulate Garlic Coin? Yeah. So I'm just going through Twitter here. Jim Iorio, it's a simple concept that confuses many. There is a level of taxation wherein any hikes will result in less revenue, and any cut, talking about tax hikes or tax cuts, will result. Oh, it's a rate cut. That's the word that we were looking for the other day. It was a cut. Not a decrease, but you could say it's a hike and a cut. The opposite of a hike is a cut. And a cut will result in more revenue. No one knows exactly what that level is, but it exists. Also, taxes are higher than they've ever been in this country. Well, he's correct. I remember when Donald Trump redid the tax system, and the big argument was that the liberals said that it would result in less revenue. And it did not. In fact, revenue increased in line with the trend that it always has. So basically, we got all of those tax changes for no real downside to it. Now, the left turned around and said, well, the tax revenue would have been even higher had we not done that cut. I don't agree, but they can't prove that, right? But Jim points out the key thing here, which is that government outlays as a percent of GDP are the highest that it's ever been. So government is spending as much as it ever has. And what your exact tax rate is doesn't necessarily matter, because if they don't pay for it in taxes, then you pay for it in inflation. So their argument, I think that there's a very strong argument that government needs to cut back right now, which is kind of a problem when you put it into context with all of the other macro things that we've got going on here, right? Because, you know, if higher interest rates lead to a recession, I mean, this is the kind of the funny thing is we talked earlier about like, oh, hyperinflation could come. Yeah, but the effects of monetary policy are lagged, so it could be a recession is coming. You know, I feel like this rise in interest rates, it reminds me very much of the market that we had in 2019. And you remember in 2019 where the treasuries were buying like crazy, and it was like, okay, I'm not exactly sure why they're buying this hard, but they sure seem to be acting like they think they know something. And then the pandemic happened, so we can't really explain why the treasuries seemed to know what was happening without going into conspiracy theory territory, right? But it feels very much like that, like the market, like that the treasuries think that a recession is going to come or something. Or I guess I could say, you know, if I come back to our chart here, I think that probably most of this action from September to November was probably unjustified. So I guess we're just back to a reasonable level. But if we start pushing some of these more crazier levels, like say back to April and May and so forth, then I start to be a little bit like, what's going on here? So you need to decrease government spending. But then how do you do that if we're going to go into a recession? Okay, what's this question, Marcus? I want to pick your brain. Since the market is expecting a lower rate environment next, you'd think risk is back on the menu, but I'm looking particularly at PLTR, and it's down 1.6%. Oh, really? Well, okay, so I think that this morning you're going to see pullbacks, right? So let's just pull PLTR up, because I'm going to bet you that they did pretty good on Friday, didn't they? Let's see. Am I not logged in? Come on. Oh, sign in with Google. Come on. TradingView has been acting weird. PLTR. Let's put it on a 5-minute chart here. Okay, so on Friday, I would say on Friday it did pretty okay. There was a decent rise overnight. You're saying it's down. I guess I'm not getting data yet, but it looks to me like there was some buying on Friday, and it's just kind of retracing a little bit. Let's see if I can get to my chart where we can see things a little bit better. Maybe if I just do it with my email. Might need to reset the password. Aha. Okay, that got me in. For some reason, it won't link to my Google account correctly. But now you can kind of come in and you can see, aha, and it will show me the overnight action. So you can see here on Friday, it was up pretty good. It was up pretty good. And then a little bit of extension in the overnight. So I think that this is just kind of the mean reversion that you're seeing across the market. So the shift that you're seeing is the Magnificent Seven, which have been for the past few months like the only reason the S&P 500 has been moving up, right? What has happened now is that they are starting to price for lower interest rates, and so they are starting to move out of the Magnificent Seven and going into small cap stocks. So I think that you are correct that that would generally benefit Palantir, but you're going to see, because it was such a big extreme move on Friday, you are going to see it kind of settle back, because basically what's happening is people are buying like big block orders, right? Large meta orders, big institutions jumping into all of these stocks, pushing things up, and now they're done. And when they're done and you're like in the overnight market and everything, they're going to settle back down. That's always, this is kind of like a, this is one of our stylized behaviors, okay? Is that after a large meta order, there is a post-meta order mean reversion. And normally we're only thinking about it on like a daily basis, you know, like we saw a strong move and then you should see it kind of come back like that right there. But it also kind of tends to happen on daily basis that there is, you know, with the CTAs being involved and things like that, you'll get period of mean reversion. So now the other thing that I would say though is I'm not sure that PLTR is going to be the place. I wonder, can I go back and see? Well, no, let's go to another trading view tool. Let's go to their screener. Okay. And I want performance on a 1 week basis, sort descending. And then I also want market cap. Let's see here. I don't want shrimp and micro caps, but let's say 300 million and above. 300 and above. Okay. Newegg has been one that has been up pretty big. That might be an interesting play. I think we need to go a little bit bigger than that. Let's say 2 billion and above. Foot Locker? I don't know if that one makes sense. GameStop is up. That's probably short squeezing. Coinbase. Coinbase might be not a bad play here. Let me come back over here. Coinbase. Whew. Oh, they really jumped overnight, didn't they? I want to see more like a daily chart. Okay. I would prefer to get it, but I would prefer to have it from 80, obviously, but it may continue. I don't think that the cryptocurrencies are going to back off here, but Carvana might be one. Okay, so hold up. We just got a little bit of a sell here. Quite an aggressive one. ECB's Lagarde is supposed to be speaking in a minute. Oh, let's see here. JP Morgan Private Bank says it's time to lock in the long end. I can just close this one. Let me read this real quick. JP Morgan Private Bank is out with its outlook for 2024, and they mostly paint between the lines, seeing inflation coming down and equities heading to new highs. If you're looking for optimism, number one, inflation's cooling, but stay sharp. Inflation will likely settle, the report states, but warns against complacency. Equities and real assets are recommended as hedges against this lingering inflation threat. We expect developed world inflation will similarly settle between 2% and 2.5%, with more variability than existed in the 2010s. Two bonds, the new contenders bonds, are more competitive with stocks, the report declares, signaling a shift in the investment landscape. This isn't just a subtle change, it's a rare reset, and they're urging investors to lock in these higher yields. They also warn this is as good as it gets for cash yields and urge clients to increase allocations to non-cash assets. Holding more cash in the near term may not be a poor decision, but likely isn't the best one either. Equities marching to new highs with AI's beat. The report boldly claims equities seem to be on the march to new highs. Why? AI is the game changer here. The report doesn't just see AI as a tech trend. It's a fundamental reshaper of market dynamics. The report notes incorporating AI and machine learning into our processes could deliver more than $1 billion in impact this year. It's a significant bet on the transformative power of AI across sectors. Credit stress contained but crafty. There is a warning about pockets of credit stress that are likely to remain limited. It's a heads up to investors to stay vigilant in the credit area, particularly in areas like real estate and private credit. Big shift to a new interest rate world. The report reminisces about a time when nearly 30% of all global investment debt traded with a negative yield, but now we're in a new era with yields soaring past 4%. It's a historic shift and a game changer for investors, offering more choices than at any time since the global financial crisis. Tackling inflation isn't just about bracing for impact, it's about being strategic. This report suggests equities, noting U.S. consumer prices have risen almost 19%. S&P 500 earnings are up over 35%. They also highlight the allure of real assets in this environment, stating as commodities and labor become more costly, existing buildings tend to appreciate. Where to buy equities? Question. While we prefer the U.S. stock market in 2024, low valuations elsewhere suggest that prices already anticipate bad news for corporate profits, limiting the downside for stock performance. Credit markets tight but tolerable. Higher interest rates are squeezing credit availability, but the report sees this as a manageable issue. They're not expecting these stresses to spiral into a 2024 recession, a somewhat reassuring note for investors eyeing the credit landscape warily. And India, a promising spot. In most emerging market economies, corporate earnings have failed to keep pace with GDP growth, but JP Morgan notes that India is a striking exception. They see 10% nominal GDP growth for the next 10 to 15 years. In our view, this makes India one of the most compelling investment destinations in emerging markets. I agree. So, I don't think that that's what drove that news right there. We did get Lagarde's full speech now. I don't know what she said. Perhaps it was in reaction to Lagarde, although it seemed to move before her speech came out. Very curious, but pretty strong selling across the board, real volume in it as well. Okay, so back to what we were doing. We were talking about Carvana. Oh yeah, it was a big. It was a big on Friday. It is. I guess what I would say is that if I was looking for plays here on the mean reversion, I think that you probably could get away with the old staples like Carvana, GameStop, that basically all of those kind of short squeeze stocks. But I think for the longer term, I would probably rather be in something that's a little bit more fundamentally sound. And so it will probably be a new set of small cap stocks that have not taken off yet that go. And in particular, if there's anything related to semiconductors, AI, etc., that we can find that's a small cap, I would probably be most interested in those. That's kind of what I was looking for when I was coming down this. I guess Coinbase might be one, but then you're exposed to cryptocurrency risk. Asus Tech, that might be one. ACUUY. They've had some troubles lately. Sorry, ASUUY, right? Yeah. This is an over-the-counter. And it's $50? Okay. Urban Outfitters. For Riot Platforms, maybe? They a small cap? Oh, they don't look like they're going. That one might be worth looking into. Or is that the Riot that I think it is? Riot Platforms. And actually, it sounds like it's a cryptocurrency place, so. So as mining difficulty is set to double soon, yeah, it sounds like they're primarily I don't think it's like Riot Games. I think that they're a cryptocurrency play. Rolls Royce. Salesforce might be one for you. CRM. Oh, that's funny that their ticker is CRM. Holy shnikes. Oh man. Okay, so that's more like what I was looking for, right? Is like, here's a tech. I wouldn't say that they're like an AI play, but here's a tech company that is benefiting very strongly from the rotation that we've seen the past like 2-day trading days, right? So that one is pretty. That's pretty good looking. Oh, and then you get into Etsy and Snap. HashiCorp? HashiCorp might be one. Let's see, HCP. Oh, I like that. I like that. Oof. But wait, there must be news. There must be news on HashiCorp. That might be a good play for me to... I didn't know that they were a stock. That might be a good way for me to replace my investment in Sumo Logic that got taken off of the market. And now HashiCorp has had foibles as well. I'm not actually sure I really like them, but they must have had earnings or something? No. I don't see any news listed there on Yahoo. Let's go to Google. There's the treasuries. They take another sell there. I wish I knew what was prompting that selling. It must just be that there's some meta orders that they have to sell today. HCP. Tools. Anytime past week. That's interesting. Twitter. HashiCorp had an unusually high call volume. Okay. By the way, I have the title correct for today, right? It's the 4th. Yep. Well, I hate buying after a really big jump like that. But I'm going to be watching that one. I'm going to be... So let me pull out my spreadsheet here. Oh, I don't have it on this machine yet. Oh. Okay. Actually, I do have it over here, but I don't think I have Excel installed. No, I don't. So I can't do that today. So I just need to remember to add HashiCorp. There's a 3K print in ZF. I like how AI pump up does not taking factor the increase in unemployment. I don't think that it will increase unemployment, to be honest with you. I really don't. I think that, okay, so like, did the internet increase unemployment? And you're probably thinking to yourself, well, no, of course, that's ridiculous that the internet would increase unemployment, because all that the internet did was just provide more opportunities for people, for companies and businesses, right? But if you really think about it, none of those businesses that we have here on the internet, very, very few, except for those that are related to the internet and the computer infrastructure itself, those companies like Amazon, there was companies that sold books before Amazon came along. There was companies that sold pretty much all of the products that were at Amazon before they were, right? All that Amazon did was leverage the power of the internet to harvest those efficiency improvements, right? So it will be the same thing with AI. There will be an industry that will show up that will be all about developing AI models. So if you're going to go into computer science, you absolutely want to be in the data engineer, artificial intelligence kind of pipeline. That's where things are going, right? But what's going to happen is existing companies are going to learn to leverage AI to harvest those productivity increases. And what it will mean is that they will be able to do more. So it is likely, in my opinion, and I know that this is the minority opinion, but I believe that AI will just create more jobs. That's what always happens in history, whether it's the internet, industrialization, basically every large productivity increase that's come along, there's always people that are concerned about jobs going away, right? The car is going to replace all of these jobs related to the horse industry. But then what happens is the industry that pops up ends up being much, much larger than the original one. So yes, if you are in an industry where you will have to compete with artificial intelligence, like you draw pictures you make websites, you're doing this kind of creative content stuff, then AI is a big threat to you. But I think that overall it will be a boon to the economy and markets in general. And if anything, I think that we should see a day in the future. Of course, there's a lot of problems for us to overcome, but I can see a time in the future when people just don't have to work as much. But there's a lot of problems in the economy that we're going to have to deal with first, because there are some things. It's not just about taxes. Like, government does need to spend less, but that's not the larger problems that are kind of resulting in the money not making it to all parts of the economy, right? Okay, now you also mentioned Docu. Did I look that one up yet? DocuSign? DocuSign's probably a massive winner too. Oh, yeah, I really like that one. Really like that one. So, HashiCorp and DocuSign. Have you ever heard of Moore's Law? Yeah, it's kind of slowing down, right? So I think where it becomes pertinent here is, does Moore's Law apply to artificial intelligence? Probably not. So I was seeing a story just the other day. Sorry, let me just put a thing in here for Docu. Was that the only ones that we had looked at? Yeah. Because I can always watch the stream back again if there was other ones that I want to look up. It does sure seem to me like HashiCorp and DocuSign are benefiting from the rotation itself, and not necessarily any kind of individual news in those stocks. So if that's good sign for those stocks. Yeah, so anyways, there was a story, and I forget who it was saying this, but some big tech guy that is in the AI tech area was saying that ChatGPT 5 will not really be all that much better from ChatGPT 4. That the difference from 3 to 4 was kind of marginal, right? So what has happened is we've made a really huge leap, and it wasn't even so much a leap in the artificial intelligence technology as much as it was the application of it, right? Like, all of those improvements and kind of models had already been around, and all they did was just create a company of employees that provide the reinforcement learning for the algorithm, and then made it available to everybody, right? So I think that in order to see like Moore's Law apply to ChatGPT itself, there's some things kind of holding that back, because basically what happens is you would go in and you would say, well, so this one has like 1 billion factors or whatever, so what if we increased it to 2 billion factors? And there is a point at which you start to get diminishing returns with that. So if you're going to have another big shift with AI, in terms of like AI growing more powerful, it would have to come from another large innovation being developed, which could happen. But when you're reliant on really big innovations, then you kind of get into where Moore's Law doesn't keep up. With chips, for the longest time, it was like, well, that is the best chip that we can make today. But they knew where they could go next, right? And they knew that it was kind of like an incremental thing in the investment that they were going to put in everything. I don't think it's quite the same thing with AI. Now, in terms of the stock market, you'll continue to see it grow because it's going to take people decades to fully leverage and take advantage of these improvements in productivity that artificial intelligence brings us, right? But I know that, for instance, in my job, that AI just gives us more work, right? AI can't do my job, not yet, and that's just another cog in the system that I have to monitor and keep working. So, anyways, so I did that. I'm sorry, I was like very disjointed. I came back and forth, but I hope that I answered Marcus's question there sufficiently. So that brings me back now to thinking about the S&P 500 and the selling that we've had. We do appear to have formed a bit of a liquidity hole. 14,000 contracts traded at 10. That move definitely makes me think there are large players in the market. I cannot tie that move, and it's now been like what kind of happens. Well, this will really zoom in here. So it really happened about 20 minutes ago. So I'm just going to come back into my Twitter. So, U.S. filling SPR as much as we can, Deputy Energy Secretary says via Bloomberg. That JP Morgan report came out. Effective funds rate unchanged. Lagarde's full speech. Kramer, we have had such a huge rally. Anybody who thinks we can continue this momentum has to take pause. Meanwhile, late on Friday, same guy, this rally reminds me of some of the great 1980s and 1990 rallies where rates would go down and stocks would soar. I'm not sure people realize how truly powerful this rally is. It is extraordinary. Jimmy. My bias for TLT options this week to the downside. That's just based on the options activity that you're seeing? Well, I definitely think that the treasuries should mean revert a little bit today, but like how much? How much that sell was about... We'll give it a 10,000. There was a 10,000 sell. That's about as much as I would expect on a Monday if there's not any kind of like bigger thing going on. But you never know. Let's see here. Mark Lukomsky. I just got here. I've been buying PLTR at $5. The stock is super extended right now, so it being down on a risk day is absolutely normal considering the 200% run up recently. Yes. Well, and the issue that I have with PLTR in particular is that it's a shit company, man. like you got to go back into the history and the context of it, right? Because the context of it was, oh, this company really sucks, and then they put out a really controversial ad, and there was all of this media attention, and then the pandemic came along. And so they became a darling stock during the pandemic, and they were making a lot of money because a lot of people bought the product during the pandemic. Now the pandemic is over and people are realizing that it's really just an overpriced bicycle with an iPad on it. And, they came back after that 2021 bull market like crazy. So now what's happening, now that they've come all the way back, is these guys are saying, oh, well, it was only down because interest rates rose. And so now it should buy up again. And so what's driving the stock is not necessarily that it's a great stock or that the economic environment is going to be great for the company. I mean, I suppose that lower interest rates does help them. Of course it does. But it doesn't change the fact that it's an overpriced iPad and that most people don't want them anymore now that they've realized that it's kind of a crappy deal. But you've got all of the meme stock guys, and there's all this money that is they're still kind of invested in this thing. And so you're probably going to see those same stocks rise. is just, I don't think those are going to be the biggest winners. I think the biggest winners are going to be small cap stocks that had kind of been ignored. I'm sure that if I was still able to have my Sumo Logic, I would have held it if they hadn't have sold out. Idiots sold at the bottom. So pissed about that one. But I bet you that my Sumo Logic would be up 20-30% as well, because it was a small cap stock that got ignored essentially, and had a positive future because that comes into the infrastructure and the data analytics side of things. Yeah, I need to see how the software helps. You see different reactions from different clients. I don't know enough about tech like that to give an opinion, but the stock, they were debt-free but kept down. Wait, who's Marcus? Oh, Marcus Banda. There he is. Yeah. Well, yeah. Now that is the thing. If I was making a play on the cloud, it's absolutely Microsoft. Okay, like look, Amazon. Just so this is stuff that I know. This is my life. Okay. Well, this is my day job. Okay. Amazon has the largest data center. Okay. I don't know how they ended up being that one, the one, I guess you could say, but Amazon has built a really big data center, right? So you would think that if I wanted to make money from the data center play, it would be Amazon. But Amazon earnings come a lot from their other business, so it's not actually a very good play from it, and they don't have as much growth ahead of them because they've already become very, very large. Whereas if you go over to Microsoft, you're going to get a case where the move to the cloud is going to be a larger portion of their future profits then the cloud is going to be a portion of the future profits for Amazon. In addition to that, Azure, is it AWS? We got Amazon, or no, that's AWS is Amazon Web Services, but the product for Microsoft is called Azure, and it's a really good platform. It's a really good platform, and in many respects, I prefer it over AWS. And especially with all of these companies out there that are kind of already locked into the Microsoft ecosystem, when they start moving over to the cloud, they're going to want to do it through Azure. They're going to want to do it through Azure. So I think that Microsoft is a really good tech play right now. And there's a reason why it's the darling. If there's like a no-brainer, big cap stock that you want to be long out there, I think it's Microsoft. Of course, because of that, that means that there's risks associated with that too, because when you get one that's that obvious, they often screw it up, right? So we shouldn't say that there's not risks involved. But I thought many, many times of taking the money that I had in Sumo Logic and putting it into Microsoft, and I didn't because I knew that there was like a seasonal decline coming. That was like in October. Kind of seems to me like Microsoft did not give me the pullback that I wanted, right? So, and in addition to that, I want my tech play to be a small cap tech play. So I didn't get in it. Maybe if I was managing a larger wad, I would have gotten into Microsoft back in like September, but I guess I only missed out on $30 a share. That's still a decent win. I'm a little concerned about, so these stocks that I've got now on my list, I've got to be, really, because the temptation is going to be go out and buy them right now, right? I don't think that you want to buy them the day after a big move like that. Okay, what's your opinion on electric vehicles? Do you think they'll ever actually replace internal combustion engines? So, it's a good question. But I think that I come down with kind of the larger narrative change that we've seen, and it really feels like just only after the last few months. And it's this: electric vehicles are not a solution to the climate change crisis. Now, if you haven't watched before, you got to remember that my opinion on the climate crisis is I'm agnostic. I'm not a weather scientist, so I don't really care because it's just not my specialty. Whether it is or it isn't, I've seen a lot of people argue over whether it is or it isn't. I don't have time to go into all of that. And I know that people would say, this is the most important thing ever. When people tell you that, they're usually full of shit, right? Okay. If there is a climate change crisis, that sounds like an opportunity to make money. Okay. And there certainly has been opportunities to make money off of that. But I don't think one of the issues that I see is that if there is a climate change crisis coming, a lot of the things that we're doing right now are not the things that are going to help you resolve that crisis. For instance, propping up green industries with government money and making them dependent on government money instead of just allowing the market to find competitive solutions to things it's not a good policy to do this. What you did it with Obama, now you're doing it with Biden. They put money into these EV or green startups, and then it goes bust, and all that government money was wasted because the government is just, when you do that, you don't get the best quality. You don't put the money into the products that are the most likely to succeed. You just put money into anything that you can, right? So thus it is with electric vehicles. They put a lot of money into subsidies for electric vehicles, and the reason why Tesla was returning a profit was because of the electric vehicle subsidies. But it's not the solution. It requires a tremendous amount of rare earth minerals that quite frankly require really scary levels of subjugation of like the people are like mining in these artesian mines for cobalt and stuff like that. Like, it's just absolutely insane. And the damage that processing these rare earth minerals in China does to the environment is just unreal. Frankly, I think that the damage to the environment that you're doing by building all of these batteries is in many ways worse than the climate crisis, than the global warming issue, right? So the reality is that the best technology that we have right now is more hybrid, right? A very, very efficient internal combustion engine that is assisted by by a battery of some sort, like these ones where when you brake, that energy goes into a wheel and charges your battery up, and then the battery kind of assists the engine, right? That way you're able to get that raw power that from the engine. That if electric vehicles can be faster, but they're not very efficient when they're that fast, right? Internal combustion engine, you can get that power much more efficiently, right? And then you supplement it with the batteries so that over the long haul, you get these energy efficiencies, and that's where you can get these electric vehicles that are now like 80 miles to the gallon or something like that. Yeah, regenerative braking. Yes. So, if you were to buy a car today and you were going to buy the one that would be the best for the environment, it would probably be a hybrid. It would probably be a Prius, okay? And not a Tesla. Now, what has happened in the last month or two is that it seems like the whole market has kind of realized this all at once. So I think they're correct. And that doesn't mean that there won't be runs on the electric vehicle market in the future again, but like people aren't just buying them, just aren't buying. And that's another issue, is that the infrastructure for electric vehicles just isn't there. The environment just isn't there. Most people don't even have the infrastructure set up in their house to be able to have a charging station. Like there's many people, they're like, oh, you know, I got the money. I'm going to buy the car. I'm going to buy the station. I'm going to have them install it in my garage. And then they find out that the electricity that their house has been installed with just isn't good enough to be able to handle a charging station. So then they have this electric vehicle and they have to go and get it charged, you know, other places, which is just terrible. Not terrible. It sucks if you're in that situation. And then if everybody did have their own vehicle charging station at night, then you would get all of this electricity usage at night that our electrical grid is not capable of handling. And that's also at night is when the renewable energy sources don't work as well. There's not as much wind and solar and all that at night. So you're just making your energy problems worse. You end up using more like coal and fossil fuels to power your electrical grid, right? So the reality is that electric vehicles are not the solution we thought they were like 10, 20 years ago when this all started. I mean, it was good that that the technology has developed, but we need to take a step back, right? And yeah, I remember when it was 2021 and Tesla was the hot stock. Well, I mean, Tesla's always been the hot stock, but it was particularly hot back then. And I said, nope, I'm not going to do it. In fact, I actually went short, and that was a short bet. There's no way that I would have had enough money to hold the risk, but I did it on a sim account on my Thinkorswim paper. And, you know, it worked. It was amazing. It was an amazing trade. Although I think that I can't, if I were to pull it up and show it to you, the results you get would be better than they were because there was that reverse split and their sim platform did not factor in the split correctly. So treasuries so there was the liquidity hole. They then tried to make a little move up. That kind of failed out. They came back in here. Now that they've come back in here, they've been trading across this whole 09.5 to 11. So you've got about a 4-tick range here, which is a little bit wider than usual in the treasuries. I'd say liquidity looks pretty good. The volume, actually in the 10-year volume, has been slightly long. So I'm not seeing a whole lot of evidence to support that the treasuries still have big players going into it, but there does appear to be some sort of a cap right here. Well, I think I need to blow my nose here, so hang on. Yeah, I think I need more time. I need to drink more water. I think that it's all up in my head and dripping down. So, it's curious. On Mondays, I want to spend more time talking about stocks, so I'm really glad that you guys asked a bunch of questions about stocks. Because normally, I kind of will just get distracted, you know, and forget about it. That's what I want to do on Mondays. But I find it curious. Viewership is actually a little lighter than normal. Unless I'm misreading these. Yeah, no, I'd say it's a little bit lighter than usual for some reason today. Maybe it's just because it's a Monday. Maybe people don't want to talk about stocks, though. We want to take trades in the treasuries. Well, I would have loved to have taken it part in that short, but, it really looked like a news move without a catalyst. So, that's okay. We sit them out. You don't have to trade, right? What's Elon Musk tweeting about? Life is kind of like a party. You invite a ton of people. Some leave early, some stay all night, some laugh with you, some laugh at you, and some show up really late. But in the end, after the fun, there are a few who just stay to help you clean up the mess, and most of the time, they aren't even the ones who made the mess. These people are your true friends in life. They're the only ones who matter. Okay. Elon, you concern me sometimes. Israel says its ground forces are operating across all of Gaza now, okay? I should just note that the seller cost basis is right here at 11.5, and that seems to be acting as a cap. Earlier this week, many businesses received an email with a header asking, did you take the necessary steps required to access business services online? Employer services, the filing deadline for wage reporting is approaching. And some people said, is it real? Actually, yes, it is. A few years ago, the IRS regulations requiring that information returns be filed electronically if a taxpayer must file 250 or more in a calendar year. The regulations provide that the 250 return threshold is applied separately to each type of information return covered under the regulations. Probably doesn't apply to any of us, right? Part of me is like, oh, I wish I had 250 employees, but another part of me is like, nah, I think that 250 employees is too much for me. Okay, there's some decent bids building underneath of this now that they're starting to pressure the buyer cost basis. I don't really feel comfortable taking a long here, though. Like, I'm looking at this and going, are they going to try and push it all the way back across and get to like 16? But when I look at that, I think that seems kind of crazy. I think that they're just going to probably stay capped here. In fact, like some of the big bids there just disappeared. So that was this is maybe an opportunity to go short. But I guess my larger term, like, what are the flows that I'm anticipating? Well, mean reversion. Our mean reversion isn't a really strong one, right? Some selling came in on something I don't know what it was. S&P 500 is buying back up. So I think I'm going to say I don't have a strong enough imbalance in my anticipated flows to try and make a call here. But what I see the treasuries doing in the flows do suggest to me that something is going on here. Whether the next move is up or down, I can't say. Well, your Zero Hedge has a story about key events this week. Gotcha. Yeah. So this one, something else I wanted to talk about. Spotify fires 17% of workforce before Christmas. That's a little wild. Like, to do it just before Christmas, a big company like that, they must have real problems. They must be having real problems to need to do it that quickly. Yeah. Well, let's read this story by Zero Hedge about key events this jobs week. After a week that tracked global PMIs and sliding inflation and ushered in the Fed's quiet period with a fireside chat bang, this week all roads point to payrolls on Friday with the usual buildup via JOLTS tomorrow and ADP on Wednesday. Elsewhere, in the US, Deutsche Bank's Jim Reed notes that the service's ISM is out tomorrow. We will also watch the unemployment subcomponent ahead of payrolls, and the initial read on inflation expectations in the University of Michigan confidence sentiment release Friday will be of note after 5 to 10 year expectations ticked up to a decade high of 3.2% last month. As a reminder, the Fed are now on a blackout period ahead of next week's FOMC, so some of the big catalysts for moves as of late, i.e. Fed speakers, won't be there. Around the globe, other highlights include a few important releases in Germany, including the trade balance today, factory orders, and industrial production Thursday. Industrial production indicators are also due in France and Italy. Retail sales data is out for the Eurozone on Wednesday. In China, Caixin Services PMI tomorrow and trade balance figures Thursday are the highlights. Tokyo CPI is out just before midnight tonight, so there's a lot of key data points for not just in the United States. I thought we rolled today, but Ninja Trader is not rolled for what? The treasuries? Not for ES. I think ES it's Thursday. Am I wrong? Oh, actually, it's not Thursday. It's next Thursday. Digging a bit deeper into the U.S. employment picture, Deutsche Bank's U.S. economists expect headline and private payrolls to come in at 130K with consensus at 180 and 160 respectively. The returning post-strike auto workers will boost the data by around 30K. Unemployment is expected to hold steady at 3.9% according to consensus, although DB economists see the risks tilted to a 3.8%. One thing economists look at carefully is the diffusion index that shows the breadth of job gains. It's currently at 52%, its lowest rate since the pandemic. They show that 70% of the private job gains in the last year come from only two sectors, namely the leisure and hospitality and private education and healthcare. Outside of that, job creation in the last 12 months is a very lowly spot 7%, just spot 2% over the last 6. Saying with U.S. labor markets, the JOLTS data tomorrow is also important, even if it's October data. And while the hiring and quits rates were at or below their 2019 averages in September, the layoffs and discharges rate remained near historical lows, so that gap is keeping labor markets tight for now. DB's case that the demand for labor eases in the next few months. Finally, thanks to way too many public companies, quarter 3 earnings season is still going on with just a month left until quarter 4 earnings season begins, thanks to the following stragglers, and then he has a list of them. Finally, turning to just the U.S., Goldman writes that the key economic data released this week is the payrolls report on Friday. There are no speaking engagements. GS believes that it will be 238 versus a consensus of 180. We estimate non-farms payrolls rose by 238 in November, reflecting 200K underlying gain plus a 38K boost from the return of striking workers. Big data employment indicators were generally strong in the month. While initial jobless claims rebounded, they remain at levels consistent with a low pace of layoff activity. We estimate that the unemployment rate declined 0.1% to 3.8%, reflecting a rebound in household employment following a sharp drop in October. We assume labor force participation was unchanged at 62.7. We estimate a 0.25% increase in average hourly earnings. That lowers the 1 year rate by 0.2 to 3.9%. Okay, interesting. Oh yeah, Treasury's already rolled. Well, hearing that Goldman Sachs is expecting a big number compared to everybody else is a little concerning to me. I'm not going to say that they're always super accurate, but I always give heed to their estimate. You taking any quick scalps around here? No. So I think that at the moment, this is definitely showing us behavior that you could probably take a few ticks from it in the 10-year. But I'm seeing overall activity that kind of suggests that something is going on. So I think the risk of them getting squeezed out of this liquidity hole is a little higher than normal. So I'm not, because I started to think about taking a trade, but I don't know. Like what's happening right now is we're right at the seller cost basis, and that seems to be putting a cap on things. So I think if my read for the flows is that we continue to be mean reversion, I could probably sell 12 and make like 11. Okay, that would be a fill. But I don't know what caused us to sell down here in the first place. The flows do appear to be buying through here. So I don't think I can justify that one. So then I could turn around and I could say I could buy 12. Well, yes, and maybe we could buy 12 and it goes to 16. But you're at the high end of the range, the whole, so you don't get very good risk reward on that one. So I don't think that this situation is set up very well for me to take a trade. That's why I've kind of been coming in and doing some reading about the financial reports and stuff. This is going to be a really key data week, right? And then next week we get the Fed meeting, and then after the Fed meeting and CPIs. Let's see here. Am I correct about that? Or is it 2 weeks? I forget. Next week. Oh. So I remember the last time that this happened, but it hasn't happened in a while. Next week we get PPI. So CPI is on Tuesday, and then we get PPI on Wednesday, the same day as the FOMC. And then core retail sales. After that, the week after that, going into Christmas, consumer confidence, GDP, PCE, U of M, consumer sentiment. So I guess next week will probably be okay trading. Then after that, it's like, nothing happens, sort of thing. And another thing I'm just noticing here, Octavia says he's not doing anything. So he's in line with me. We did have this sell right here, right? But then since then it's been nothing but up. So nothing but up, even though it's been like really, really tight. So but then that has kind of moderated a little bit. So my expectation is it probably continues to do this for a little while. See, we're not quite out. Actually, we are. We're out of the liquidity hole area, but it's being super tight here. So I don't know. seeing us, there's a big move. It's been 45 minutes. Seeing it still trading kind of tight is a little bit concerning. Like now is when I would be looking for like a new meta order coming in, and instead of a new meta order coming in, we're just wobbling in this one little area really tightly. It's a little weird. Well, I did say, oh, if you turn around and buy it at 120, maybe that works and you get 16, but you don't get good risk reward. Well, so far you got 3 ticks since I said that. So that tick or two right there seemed like a breakout. So first thing that I would say is that now you might be tempted, oh, let's jump on board. But that's like the fake breakout, revert back to the range risk right there. So this is definitely too late now. But 15 is the buyer cost basis. So let's just give it a bit and see where they go. Okay, iceberging at 14. That looks strong. That looks real strong. Well, no, I'm not going to ban this guy, but that's a weirdo in Discord there. Perhaps some CTAs and otherwise thought that pullback was a great opportunity to buy it back up. I don't know. Very interesting, but you did get the seller cost basis there, 15 now, so it did kind of come across. I'm wondering here. It seems like I've been noticing my cost basis indicators more than normal. And the last few times when let's say I've had feelings that they were either going to mean revert there or they were going to cross back, between the two of them, that I was correct. So, and I've kind of been looking at it from the perspective of if they've continued to sell volatility, that this trade back and forth between the two cost bases will become more effective. So this is like the second or third time that I've looked at it and I've been like, well, here's one that would be across. Last time I actually took it and that one worked, but then I believe after that it worked, there was like a big move came out and just, dislocated things. So I don't think I completely trust it yet. Just because I don't know if I'm actually picking up on a signal or if it's just luck. Okay, we do have some news at the top of the hour, huh? And we're seeing the liquidity pull for that. So the number that we're looking for, U.S. factory orders month over month, is negative 3% versus a previous reading of 2.8%. Oh, you know what? I should come in here and there we go. Bring the seconds back. Okay, so it was more negative than anticipated. Negative 3.6. So that would be good for treasuries, generally speaking. That means that they're not buying as much, ordering as much stuff. Sign of a weakening economy. But perhaps the move up that we saw was them front running that. My beard is starting to like tickle my face. It's time to trim it down tomorrow. Okay, well, they seem to be holding after the news. Do you think they'll break the regular session high / open at 16? Liquidity is still a little suspect. There's some spots of offer above us that they're not putting on. So if we did have some sort of a like let's say a level break sort of a trade. Oh geez, okay. I'll do it as she goes. I'm kind of thinking that they might sweep through this area really easily. That time they didn't even wait for like the see if there was absorption on the bid. They just went for it. So that's, I would say, a sign that they're being pretty aggressive, right? This one I would say is much more technical of a trade than I anticipate, because I'm still not quite sure I see what would be driving the long flows here other than that piece of news that we got. But I think that the technical setup and the piece of news that we got and the amount of trend that we've seen to the upside so far already gives you a pretty good chance at this one. So I'm going to try and pull something out here. Now, decent amount traded at 17. That, by the way, takes us below 4.25 in yields. You can believe that. Basically, we've gone from 5% to 4% in the matter of like 2 weeks. It's pretty crazy. Okay, looks like they're gonna hit the 18. Ooh, that reminds me, I've got some activations to do today and other miscellaneous news or work, lyrical work, let's call it. Okay, they're coming back. Didn't touch my order at 18.5, huh? Well, that is slightly concerning to me. Cool. So I'm still seeing flows kind of coming in long, despite them starting to kind of get a little tight here again. Does kind of look like a liquidity hole. I'm also hearing stuff from the Europeans pointing out that there was a move in the bund. So this may not actually be the treasuries. Maybe it's something going on in Europe. I mean, Laguardia did speak. Japanese 10-year bond auction happening tomorrow. Well, you saw a pretty strong run up in the Japanese yen as well. So, okay, they did touch 16 there though. I'm still getting like pulling here, so I think that me trying to take this kind of area right here was probably okay, but it might be a little bit down to luck whether or not I get that second scalp there. Do I seem very chart focused today? Well, I don't know. I mean, we spent a lot of time reading stuff up until now. I definitely find this move to the upside, though, has definitely perked my interest. Not enough for me to take a live trade on it, but I did start trying to scalp it as she goes. I was sitting there with it, right? And I was like, okay, they might do as she go. They might do before she goes here, where they kind of absorb on the bid, and then it gets pushed up. And they didn't. It was the offer just evaporated, and you know, as soon as I saw that, I hit into it, and almost immediately it ticked up, and then it went for a few ticks further. Clear stop run of some sort. But they did not make it to my 18.5. Maybe I should have just taken the 18 and been out of it, but instead it came back and I scalped one. You know, I finally got a fill on one second contract, and now I took the second one and I wasn't able to get the fill on the offer, and now it's 2 ticks lower. Now it's coming back to the buyer's cost basis, So we'll see if buyers are really truly in control here, or if this move was already over. Because if they start to fail from here, I would say that kind of means the move was over. How do you differentiate orders on DOM being filled versus the ones spoofed and pulled out of the bracket? Well, so you have to look at what actually trades on the inside, right? On Jigsaw, we have this column on the inside that shows me how much traded. So I'm going to compare, you know, if they take this 15.5, you know, I'm going to compare this number, what trades here and what was right here. So if that's more than 1,000, that means they all pulled. Okay, so it was about 1,000. So that downtick was about normal. Okay, which is to say, the market makers or the limit players aren't doing anything interesting, but the market players did come in and take everything that was bid. Right? And then they did it the same way. So what I'm seeing right now is actually looks like a fairly healthy market. Fairly healthy market, although they're not really getting the bid that I would like. Late start for you, Tiger? Oh, well, that's not a good way to start a Monday, but better late than never. Something else you got to remember is that a lot of what people call spoofing are just placeholder orders. So, you know, if I'm just kind of market making or I'm executing a large order, I'll put orders at every price. And that's not because I want to take those orders at every price, but rather I want to have the spot in the line. And if we tick up, I almost guarantee you there's 2,049 at 16.5. I can almost guarantee you that about half of that will pull. It's not the robot spoofing, it's placeholders. So they're there because they want the place in line. And if the trader doesn't explicitly say, okay, I actually do want to take this many contracts here, then as soon as it ticks up, they'll pull away. So it's actually when it doesn't do that that's more interesting, right? Like if it ticked up and you got a strong bid at 16, but the 16.5 doesn't pull, then that's kind of like okay, there is a limit player on the offer that wants those, right? That just told me something significant about the limit sell orders. Now, that doesn't mean that the market buy orders aren't going to plow right through it. They could totally do that. But I'm watching all 6 of those forces. And that's kind of how you have to, you know, deal with the spoofing. Now a spoof would be like, there's 33.55 right now at 17. And if we came up here and then only 500 traded to take it bid at 17, then that's where I start to say that's spoofing. Like somebody put a big offer there to try and push the market down. They probably got filled on the bid down in here, and then they, you know, when the market came up to their order, they didn't actually want it. And we do tend to get that kind of behavior around the edges, although it's usually the other way. It's usually we break the highs, you see strong bids stack here, they go a little bit further, and then it sputters out very quickly. And those bids don't provide any support. It gives you a head fake. Yeah, this move up here is really weird. Because you see, we had a really strong move in the dollar that wasn't really given any heed by the treasuries. And then when the dollar pulled back, you saw the treasuries rally and gold fall. So, like, I'm seeing a bunch of assets, all within the treasury complex, having moved off of that move, but it did not really follow the way that in a way that makes sense at all. So I can't explain it. Well, hold on. Okay, so with me down here at 14.5 now, should I give up on this sim trade? Well, we just got a really strong uptick. That uptick also seemed to be driven by the 5 years, so now I'm starting to wonder if we're going to see something happen in the yield curve. Say the 30s. Oh, you're right. That's a good point. So while that last 2 ticks, the 5 year is further. If I had not reset it as soon, you would see that the 30 year actually is pushed up higher. So you might start to see some really interesting spread trades come in here on that, because like, let's say that somebody is starting to put on a steepener, they're going to start buying the 5 and selling the 30, and you're going to see that shift a lot. S&P 500 started out buying pretty strong, but they've net sold on the session. They came up there to 2 ticks, but they weren't nowhere close to getting my fill. They're just toying with me now. They know that I have the order at 17. They don't want to fill it. How it always goes, man. Okay, so there's this. I'm just kind of browsing around. r/Wall Street bets. Where is the money coming from? Gold is up, Bitcoin is up, SPY is up. So really my question is as simple as it gets. Where the F is the money coming from, and why now? First response. Charlie Munger's will. Yes. Charlie Munger gave away his money to a bunch of people, and now they are putting it back into the market. That makes perfect sense. What's your expectancy? Well, so I definitely do keep data on my trades because I use Journalytics, so I can go back and I can look at the statistics of all of my trades. Should note that what I've got going on right here in the treasury right now is a sim trade. And kind of a little bit, I'd say it's a serious experiment, but part of an experiment in managing longer term positions. I really don't like that. VWAP now. They're going to touch the 12. I think I might just have to puke it here, though. What was I going to say? Oh, but in terms of expectancy, so here's the thing, is that a lot of people, they'll say, I have some signal, and then I will have a profit target and a stop loss. And based on what my profit target is and stop loss, I should expect a certain win rate. And then based on the win rate that I actually get, and that kind of tells me what my expectancy is, right? Well, what I'm doing is I am trying to predict the flows pretty actively. So I'm taking all of the informational edges that I know and come out with a reading for whether we should be buying or selling at that time. Although I wouldn't really say that's what this trade doesn't completely fit into that. Because today I'd say that the flows are mixed. Okay. But I thought that maybe I could scalp a little bit in here and it didn't work, right? And in fact, let's just bail on this for now, because I don't really feel like trying to pay attention to it, and I really feel pessimistic about it coming all the way back up to the 18. Anyways, how much I make or lose on an individual trade is kind of vary, and what I would like to have is like my winner is 1.5 to 2 times my losers, and my win rate is somewhere around 50%. Right? So that means, and I would say if I was like swing trading it would probably be higher than 50%. But, I might have the overall trade correct and it just takes a long time for it to get there and I stop out before that happens. And that's where I get 50% from. Right? So that's how I would put it. Now, I usually am more like 45%. So... and I have bad months. Like October was a bad month. I was doing really, really good until October. November was good. In fact, can I take it? I don't know if for the whole month of November it's profitable. Let's see here. I just come back and do this and this. And then I limit it to only the live trades. So, account begins with a number, right? Yeah, it was a net profit. I didn't take a ton of trades last month, though, right? Those were my live trades for last month. I made $30. Yeah, it's kind of a slower month for me. But the month before that, it was pretty bad. Can you analyze Baba later? Do you mean Alibaba? I don't know if that's one that I would want to... I'm kind of concerned about any of the companies that have a ton of China risk in them right now. But have you managed to practice in regards to your risk management in the trading of the bond spreads manually? So I have at times taken some spreads in some spread trades. I don't find managing my risk on that one too hard. Because you get one side that's favorable and one side that's not favorable, and you usually know which one it is, and so you just kind of know, like, you take the side that you think is going to be harder to get filled on first, and then hit and market with the other one. And it's no big problem. But I have never been able to find a really strong edge about, like, when the spread should really be moving one way or another. whenever I think that I have a piece of information that suggests that yields should flatten or steepen, doesn't quite play out the way I anticipate. So I'm still kind of researching. I wish I could say that I was like actively reading something, but I'm still looking. So if you find any studies or books that have statistical information about the way that the yield curve tends to trade and so forth, I'd be very, very interested. Crude's getting a little bit of a jump here. Oh wow, it's a whole $1 actually. S&P 500 is very much turning risk off. I wish I could say that the treasuries were also doing that, but they're selling. I don't know. 12. So they're back to a place where if I really thought that we were a strong buy today, that I would be looking to buy. Instead, I was puking out there, so I probably should just sit on my hands. I wonder, do you think that... well, we got about 30 minutes left. We could see the bottom of this, and then you could see some stop outs on the other way, and that could be really entertaining. Yeah, I don't know. It's a weird move. That's another strong down tick. By the way, this reversal down to the bottom is not accompanied by volume at all. So, when I get a move like this, let me show you what I mean. So the treasuries, starting from about right here, they're buying, right, in cumulative delta, and what do we see? We see them move up, right? But then after that, what do we get? Very, very slight, mild selling. But price falls very, very precipitously. So the market buying, maybe not actually the biggest driver here. Now, we didn't have much time to recover. So it does look like it's a inverse law reversal. There could be more selling. If they start pushing into here, they'll start to have to push more volume to do it, but you're probably going to get a lot of people puking as well. But I can't really say that that's what's going on, because there's just not enough volume there for me to say there's like a large meta order selling. It could just be the Japanese yen. So if I minimize this, and you can see the Japanese yen over here in the upper left. They're tracking the Japanese yen very, very closely, and the dollar is pushing higher again. So this looks to me like this is a currency move, and the treasuries are not actively trading it. That means the CTAs aren't really bothering with it. It's just moving along with the correlations, and when that happens, Seth is usually not a happy customer, because I can't necessarily see all of the flows that are in the currencies. I'm usually not privy to the information that might be driving them. And so it's basically like you're trading with no edge at that point. If your edge is the treasuries and it's actually the currencies that are causing the move, then you really need to have a strong edge in the currencies in order to be making a good trade right now. So I hate these kinds of moves, but they can turn into real benders sometime. I could totally see this turning into a really ugly sell. could be that they push the lows, and then after the lows come in, you start seeing people puke. For myself, a good place to start is learning out the DVO1 when it pertains to the yield curve and considering longer intraday trades. So are you saying you calculate and or chart what the DVO1 is, and when it starts to deviate too much, you take a mean reversion trade? Oh, gee, wait, what happened to you? You were in the hospital. Oh, wait, you told us this before, didn't you? I don't recall. I'm having flashbacks. Last time I had a friend in the hospital, I'm like, oh, are you okay? He was like, oh, no, it was no big deal. And then like a month later, he died. I'm like, what? Oh, it was your dad. That's right. That's right. You're not the one that's sick. Yeah. I don't know. This is... That offer at 10.5 is looking pretty strong after that last downtick. It does look like that they're going to at least attempt to squeeze it to the downside. I suppose we could try. Oh, okay, never mind. There was icebergs right there at 10. 7 hours? Oy. Oy. I think one of the worst things is when you get a family member that is really close to end of life, because you start to feel like that you have to spend all of your time to see them as much as possible. I'd be really careful about falling into that trap, because for one, if they're really at the end there, right, they're not even conscious most of that time, right? So it's much better to, you know, like get your efficiency out of it. Because what you can end up doing is lose yourself so much in that and get completely sidetracked on all of these other things that are going on in your life. And then it takes a long time for you to recover from all of that, you know. So when that happened to my ex, it was like years until she was like back on her feet again. Okay, so there was the uptick. They come back there. I think there's still a possibility of their testing the lows, but that bit of iceberging that I saw there, I think, is very much contradicts the let's shove it through. That they've run into liquidity and they're almost immediately reacting to that. That's enough to ward me away from trying to take that continuation lower trade. Mostly towards being able to adjust the manual spread on the flat. I don't understand what you're saying at all. I'm looking for some sort of a statistically provable behavior that we can show in the yield curve that consistently holds. Whether it's caused by the dynamics of the yield curve and how the stylized behavior of order flow results in interesting behavior in spreads, or whether it relates to situations where spreads are extremely likely to mean revert. Or maybe it has something to do with some sort of a CTA style strategy in the spreads. But, you know, something that tells me from a technical perspective when is a good time to go long or short the spread. There's this thread in futures trading about grid bots versus DCA bots, and like all of the stuff that I'm seeing in there, that sounds like Bitcoin stuff, not futures stuff. Oh wow, they got shoved down there so quick. Holy shnikes. Was there a big move? And there was a big move in the dollar when that happened. So did Lagarde say something that really upset the European bond market or something? This is such a, tell you what, this will really give you a whiplash, right? Having such a strong day yesterday and then having today, like, starting out as a mean reversion, pushing all the way back up to the highs, and then just getting pummeled down to new lows. Can pick your brain on trades, quotes, and prices. I was going through this this weekend, and I got the idea that a market maker strategy works better when there's a cumulative delta divergence. So what do you think about that? I think that would probably be true. Yeah, if you were market making and they were net selling, let's say, they were net selling, but we were going up, you're getting filled on all of those sells and are actually making money as it goes up against them. That would be true. But I would say that when you get that kind of divergence sort of a thing, something weird is going on, right? Like somebody wants to sell, but correlated asset is going the other way or something like that. And I don't think that the algorithms would be able to say, oh, we're getting a divergence, so I actually want to take on more inventory or something like that. That would be really risky. But I think the bigger takeaway that I would get from the portion of the book that you were reading, right, was that the market makers intentionally insert randomness. That by inserting randomness intentionally, they improve their profits. And so that means that there are periods where they will pull their orders or stack their orders completely randomly, just to throw people off, so that price is in a straight line, essentially. Wow. How low do you think? Because this is already past like where I would have felt comfortable taking a trade. I missed it, but I should have been taking 10, right? But it's not backing off at all. The people talking about the aggressive reversal in gold. Nick Timmeros, it has been 250 days since Wall Street Journal Evan Gershokovich was detained by Russia during a reporting trip. Okay. Joseph Wang, runaway deficit spending and anticipated rate cuts suggest significant upside risk to equity prices. The wealth of private investors is rising with treasury issuance, while the desire to rebalance is also increasing, says Joseph Wang in his post titled Crash Up. You need to be a subscriber to read it. I don't have that. A little bit of a pause here at 08. Dollar still continues to be looking strong. It's such an eye-opener. Lagarde stated that she is Pepe Le Pew. It really is, because it it basically outright disproves many things that retail traders believe and just take for granted, right? Because once you start to see what are the things that we can actually prove compared to what retail traders believe will actually help you predict the markets. We're not maybe not even talking about predicting the markets, but just like describing the behavior of markets, the things that retail traders talk about and quote unquote notice aren't actually provable. And then you look at the things that actually you can prove, and it's like a completely different world. And it's like, whoa, hold up, wait a second. Was everything that I learned from technical analysis useless? Turns out mostly yes. Okay, you get an icebergs on both sides at 06.5 now as well. I tell you what, that was it sure dived down here quickly. The spread also reverted back again. Like we started moving down and well, some parts of the curve flattened, but the 2 and 10 actually steepened there a little bit, which is interesting. We're gonna get, okay, well, 45 on the bid, 3,400 on the offer. That's some pretty big iceberging. See if they tick back up there again, or if they take another few ticks. Yeah, it kind of sucks because the kind of move that we had here today, where that inverse sine law comes into play, basically, if you get a fast reversal, that liquidity below it is going to be weak. And now, I don't think it was just that. I think it was the correlation. But, you know, those can end up being some of the best trades. And it was a pretty solid trade. I mean, we had taken, if some of the prices that would have been available to us, like let's just say 425, we're already 429, so that would have been a $40 trade already, and it may go lower. So I'm sad that I missed it, but there's absolutely nothing I've seen here today that would have helped me predict this move. It's really quite a freak sell. Maybe, I guess my best theory at this point is that somebody came out here and said, you know what, all of this move about like the interest rates are going to go lower and all this nonsense from last Friday, I don't buy it, and I'm going to come in and take the opposite trade and buy the dollar on the thought that the European economy is going to go into recession, but the United States is not, and the United States will keep yields higher for longer. Hence, the yields start going back up. And the dollar, they put their money into the dollar. One of the reasons why people will get into TA is that self-excitation property of markets. Well, so that one is not necessarily what you would think though, right? So they start to get into that because this comes back into, okay, so why do we get trends? Is it because moving up causes everybody to get excited and they want to jump on board and it's bandwagoning and it just keeps pushing it, right? And turns out, no, actually that's probably not what causes it. That it's large meta orders coming in that tend to cause trends, or is more likely to be causing trends. But there are still some self-excitatory type of behaviors that occur but they're like a much more micro sort of level. So like the timing of orders tends to cluster. So you might say over an hour, you tend to get X orders per minute or something like that, or X orders per second on average. But then when you look and you'll say, oh, but I don't get that number of orders per second. It's like it will pause and nothing will happen for a long time, and then I'll get a bunch of orders all at once. So the orders tend to cluster. And there's something called, I think it's a Hawkes process, where they were able to statistically model this sort of stuff. And that's how a part of how market makers are able to adjust. Because if you just use the average, then you end up taking on too much inventory. So they kind of have to adjust for, you know what, like the orders, if they come in, they're going to come, you know, if they're going to come in and buy this, it's going to happen all at once or whatever. And I don't completely understand the math on that. That's one of the things I'd like to go back and understand better. Because you kind of have to understand a Hawkes process. There's a little bit of a pullback, but they still look pressured, and there's a big old offer at 07 holding them down. Or rather, when they came back across 07, that big offer showed up. But it's because the patterns are a result, not a prediction, right? If I'm expecting a certain thing to happen, then I should see a certain pattern that plays out. But I can't go and look at a pattern and say, here's a trade as an entry signal. That doesn't work very well. If anything, a pattern showing up on there could be an exit signal for you, right? Carl Quintilla retweeting Bespoke Invest. This would be gold's biggest intraday reversal lower since November 9th of 2020, when it closed 5.7% below its intraday high. What is the day today, by the way? Silver down 3.67%. Yeah. That's ugly. Maybe somebody's just taking advantage of the gold reverting too far. Or did I say of gold reverting too far? Let me rephrase that. Perhaps somebody is just taking advantage of gold having extended too far and leaving itself vulnerable to a reversal. Well, they don't seem too anxious to break lows again here in the treasuries. So could happen. In fact, I bet you that they might make another lower low or two. But it does kind of look like that the meta order that brought us down here has subsided. You know, it's kind of funny because remember when we were like, okay, it moved down and then it came back up And I said, I don't have anything that tells me which way it's going to move, but I do suspect that they could come back across to the buyer cost basis. And we caught that one. But I said at the time, I am getting some signals from the amount of activity on the book and everything that something is going on, but I don't know what it is. And then we moved up, and then that reversal came. So that's very, very curious. But what their angle is, I don't know. We'll probably get some reports from the desks to see what they were doing. But I suspect that it's just the counter trade coming in. That these other guys, they made a big win on Friday, and somebody else is coming in and spoiling the party now. Holy shit. Wow. So when we ticked up at 05 half, there was about a 2,000 lot or so that stacked and then pulled on there. And so somebody then came in and hit it. There was an iceberg there at 05 half, but they just plowed right through it. And we just saw about 7,000 contracts net sell at 05 half just plow through the market. That's one of the biggest sweeps we've seen in a while. There has been a few in the past few weeks, but that one was significant. And that is probably going to, when something like that happens, something like that is not supposed to happen. That could suggest that sellers are very aggressive and that we will continue to move down, but it probably constrains price movement for the time being. That becomes a really big hole. Everybody's going to notice that. The market makers are all going to adjust based off of that. So let's see. If these sellers are really desperate, then it will keep going, but otherwise it's likely to revert at 05 half. If I had taken a short and somehow was still in it at this point, I think that I would be buying at 05 half. Because that just makes me super nervous. I'm a little concerned because we had already plowed through. So this is something I haven't really thought about before, but I should pay attention to. Like 10 was kind of where we started falling out from, right? 08 half was I think the new lows. So if we've plowed through to new lows, and I'm still seeing market orders of like 7,000 contracts, what does that tell me? I mean, that's one really big seller, right? Manic Monday. Or really, the thing is that coming into this week, we knew that this week would be a relatively active week just because of all of the economic data that we're going to have. But now having such a hard reversal, that sort of thing really roils markets and increases volatility. So I would expect that we see quite a bit of volatility this week now, yeah. Whether that benefits us or hurts us, I'm not so sure. Because the issue that I still see is that I'm not entirely sure what direction the flows are going to be. Especially now that we've gotten like some mean reversion. I mean, the CTAs could flip back around and go short just as quickly as they did long, right? Let's think about that for a second. If I come back, where's my volume profile chart? Day. So I have it on day. Okay. So like, here's the CTAs. I think one of the things that I could probably put on here, let's see if I still have it. I think that this would, I hypothesize that this would be more effective at IR rock volatility, maybe? Or is it just IR rock? Yeah. So this kind of tells me the amount of volatility in the rate of change. So I'm saying this may be a proxy for what CTAs are going to do. So you got a down day here, right? They would have to sell quite a bit more to turn the CTAs short again. But can you imagine? What if, let's just say that we close where we're at today. And then tomorrow it's like this. Something like this, right? Wouldn't that be wild? That would be but just about the craziest thing that I think could happen to the markets right now. But I think a lot of people would feel super vindicated if that happened, right? like Octavia's saying, I think we'll get hyperinflation, right? Well, that's a kind of move that would make us start to be concerned about hyperinflation, wouldn't it? Just a guess. I think that one's just a guess. Sometimes I'm really good at predicting these sort of things, but I don't know if I'm be able to call it beyond maybe that. I could see it maybe selling for the next week. This really follows through, and then maybe the FOMC is negative, but after that, I'm not too sure. Huh, okay. Financial Juice tweets, Goldman prefers options to go against excessive rate cut pricing. Ah. So, like, buy TLT puts? Think that one, how much sense do you think that one makes? Well, I don't really want to go and look at my portfolio account, but oh, I'm only down 0.16. Okay, it could be worse. Only down $15 today. Options. Simple. TLT. Well, we'll do December. Well, let's only do the monthly ones. So we'll do January and February. Okay. So, in December, now that's actually really interesting. They're not really asking a whole lot for the options here, are they? Why do I have 8710 marked? Well, let's just kind of split the difference and say 90. Let's just say we want 90 puts. Only $45 an option. I could buy 2 of those options for $100. Okay. So, I buy 90s. Let's see here. Can I change? No. So we want the expiration on the 15th, I guess. 90 puts. 0.45. We'll pay up for it. Okay. So now we have 2 contracts at 90. Well, in order to make our money double, doesn't look like I have to take it very far. Changes it to the expiration day. Wow. I hate how it doesn't show you that. Their tool isn't very good. Isn't there a way for me to like dividends? I swear that there's a way for me to like mark something to say, you know, what price is it right there? Well, it would be hard for them to get back below 90 before the end of next Friday, right? It's a little bit of a stretch. It's a little bit of a stretch, but it's not crazy. It's not crazy. But what Goldman says totally makes sense to me. They're cheap. The puts are cheap, man. Those are cheap puts. If you think this is just going to revert back down, jobs report is really strong. That pushes them down. Federal Reserve is hawkish on Wednesday. CPI is high. It could totally happen. I think I would maybe rather buy a closer expiration and spend a dollar on it rather, though. Worth thinking about, though. Worth thinking about. I wonder if I come back to option, quote, and chart. DLT, let's see here. Oh, no, that's not what I want. The open interest is at 90. It's at 90 and 95. That's very interesting. Sounds like a fun trade. But you know what, guys? I got to get going. So I will see you tomorrow. Let's put in the title. Jarring reversal. Starring reversal after gold hit new highs. After gold hits new highs. That's today. We'll see. I will see you guys tomorrow. We're going to have a big week. In the meantime,